Chapter 11, Standard Costs and the Balance Scorecard. Okay, the learning objectives here. We're going to distinguish between what we mean by a standard and what we mean by budget. These are just terms. Okay, we're going to look at the advantages of developing standard costs within an organization. And we're going to state how we determine direct material and direct labor variances. I'll also demonstrate how we do total overhead variance. That's very simple. And we discuss some reporting on variances and so forth. So in this chapter then, first of all, you go through the PowerPoints and the lecture notes and the video, the brief exercises, if you will. Now, when we've talked about budgets in chapters 9 and 10. All right, a budget is not an actual amount; it's an anticipated amount, an expected amount. When we talk budgets, we're talking about total, like total manufacturing costs or budget, total direct material. When we talk standards, we're talking about an estimated amount, but on a unit basis. What is the standard amount of material that is allowed in production of our product? What's the standard unit of labor? That kind of thing is what we're talking about. Why standard costs? Well, they help us. Again, the whole idea, as we talked about, is management by exception. We have produced this product so many times. We know exactly, or we should know reasonably well, how much material should go into the production of the product, how much labor should go. So now that amount is what we call a standard. And then we use that standard in estimating prices and production costs and what have you. And when anything goes wrong or there's a difference from standard, we determine if that difference is material and whether we should examine it. All right, so it makes employees more cost conscious. It provides a basis for evaluating. It's a means of cost control. Here we go, analyzing and reporting variances. Now this is a model. We start off, and we're talking here direct material. So I'll put up here direct material. All right. What we have is number one here is the actual amount of direct material that went into the product and the actual price that I paid for that material. So it's AQ times AP. So in this problem, they actually use 4,200 pounds, if you will, times $3.10 is what they actually paid for it. So their actual costs were $13,002. Well, we move over here, 3. This is the standard quantity times the standard price. This is what we thought should have been used, and this is what we determined should have been paid. So that's SQ times SP. The standard quantity was 4,000, not 4,200. The standard was 40,000 compared to the 42, sorry, and the standard price was this. So therefore, it was 12,000. That's the difference. Now the total variance down here. The total variance is the difference between what I actually paid and what the standard was. So the total variance is 1,020. And I paid more than the standard, so it's unfavorable. Okay, that's the total. Now that total variance is a function of two things. It's a function of price, and it's a function of quantity. See, there are two factors here. Quantity and price, standard quantity and standard price. What I do to break those two out is I create a middle one here. And this I make actual quantity, which means I take the quantity from over here times standard price. I take the price over here. And so when I come up with this number, 12,600, it's just a number. But you see, the difference between 13,020 and 12,600 is the difference in price, because in this formula, the actual quantity is the same between 1 and 2. The only difference is the price, the actual price and the standard price. So this difference of 420, unfavorable, is a price variance. I paid more than I should have. Now when we go over here, you see the standard price in 2 and the standard price in 3, so the difference between 2 and 3 is the actual quantity and the standard quantity. So therefore, when I compare this number, 12,600 and 12,000, this 600 unfavorable is the quantity variance, just based on that formula. Now, that explains, and it adds up to the 1,020 unfavorable. So that's the model. This is for direct material. We'll call this direct labor. We'll just say this is direct labor. Okay? Now, what we do in direct labor is we take the actual hours worked on the product times the actual rate paid, and we get 2,100 actual hours times 1,480, and we get this number here. We move over here and we say, okay, what was the standard hours allowed to produce that product times the standard rate, and we get this result. So the difference between here, 1 and 3 down here, is the total variance. The difference between 3,108 and 30,000. And again, the actual was more than the standard, or the actual is more than the budget, so therefore it's unfavorable. I create the middle column. I take the actual hours from over here, and I take the standard rate from over here. And I come up with 31,500. 2,100 actual hours, 1,500 standard rate. I've isolated now the price variance. So the difference between here and here has to be the price, and it's 420 favorable. We move over here to compare 2 and 3. We take 31,500 and 3,000, and we get 1,500 unfavorable. So you see this unfavorable variance here is actually a function of a huge quantity variance. That is, I used more labor than I should have. But I had a favorable price variance, and that makes sense because I paid 14,800, and I thought I should have paid 1,500. Now we move to, we move to analyzing and reporting overhead. This is the overhead variance. And all you do is you take the actual overhead, fixed or variable and fixed, and we look at the applied overhead and we get this. So the standard hours allowed should have been worked for on the units produced. Right, the balanced scorecard. Initially, all managers were judged their performance was based on financial measures like return on assets, net income in their division, profit per employee, that kind of thing. The balanced scorecard is an effort in the last 10 years to expand that performance evaluation to include other factors. Factors like customer satisfaction, customer retention, how well, depending if you're in marketing, how well you've done that, how well you relate to the customer. In many areas too, it's internal processes, the production processes, how many times did I fail to deliver on time, or defective products, things of that nature. And the fourth dimension is learning and growth for employees. This is why in your area, in your businesses, if you have the balanced scorecard, they're sending you off for all kinds of courses because that's the way they're evaluated. Now here at ADU, all senior management have balanced scorecards. Each one would be a little different. Each of their targets would be different. But at the end of the year, they would measure the outcomes of each one of these products, or each one of these measurements. They're called key performance indices, KPIs, what have you. And they would be evaluated based on that. Okay, so that's it. It's just a little bit of theory here. No big thing. Chapter 11, what you have to take away, is that model for direct material variance and direct labor variance.